But yeah, like Ryan said, we're doing a upcoming special report focused on banks and non-bank lenders, so the non-prime or subprime lenders in Canada. And what I have up here is really just to highlight really the amount of exposure most people do actually have to banks, even though they don't really realize they do if you do hold ETFs. So I have XIU up, which is just an ETF tracking the TSX 60. And you can see here the big banks, they have a large share of market weighted indexes like the TSX 60, but also the composite. And then you also have financial ETFs, which people will commonly ask us about, which are just even more so dominated by the banks. So the big six banks, RBC, TD, BMO, Scotiabank, CIBC, and National Bank, come in at a cumulative weight of 27% of the TSX 60. So over a quarter of the index between the six banks, even though 1/10. So well outsized on a per stock basis. With all of them besides National, which is significantly smaller than the others, being in the top 10 holdings for a TSX 60 passive ETF. So broad market passive index investors in Canadian markets will likely have significant exposure to the big banks regardless. So when you are looking at a portfolio comprised of single stocks like we do, you do want to actually look at the big banks. You don't want to be a closeted index investor by any means. I'm not pushing towards that, but you do want to actually look at what is making up these indexes and why. And we can just see why in the historic returns right here, why. It shows the massive outperformance compared to XIU, the ETF that tracks the TSX 60 over the past 26 years, was just how long TradingView had data for, just to show this nice and simply. So you can visually see how correlated the banks are with one another as well in this. You can see during 2008, right here, with all declined together. Same with the broad index. You can see in 2020, the same thing, as well as periods of rising like right now. They're all very, very correlated. But over time, you do see this dispersion with National tripling Scotiabank's return over this period. You can see over 4,700% return, and this is dividend adjusted. So in reality, you'd likely get slightly less if it's in a taxable basis. But if it was in, which didn't exist at the time of TFSA, you would actually see these returns if you were continuously reinvesting. But the point is, you do see this dispersion. You have National followed by Royal really outperforming the other banks where they're much more closer tied together on a return basis, with CIBC being the third, which is a bit more of an outlier, but still more clumped together. But they all well outperform the TSX 60. So just looking at the performance with dividends not included, so just the price performance, the banks still actually do outperform the broad index over the same period, just less so since a higher proportion of the returns are from banks are from dividends. But even if you are just saying, I don't care about the dividends, which some people do, you should care about it. You should be looking at total return. Even on just a price basis, you can actually see some outperformance historically over the long term. There is a bit of a caveat there that because of just the time period, this is back to 1999, there was the dot-com bubble, and you can see that with XIU, there was a peak, and then it really underperformed for quite a while. But if we look at, similarly, the S&P 500, dividends adjusted here, so dividends included, reinvested, it does actually outperform the S&P 500 as well. Just to about the same degree when dividends included over this period. That's merely coincidence with the XIU and SIP or SPY performing similarly, but the point is very strong performance of the bank over the long term. But there are periods of underperformance. You can see here 3 years with dividends included even. SPY has outperformed all the banks except for National. So people will always say, why are you investing in banks? They're low risk, they're low return. But even in, this isn't a massive change difference here. And over the longer term, we can see outperformance, even when it is classically lower risk asset being a bank compared to the tech-heavy S&P. So far this year, there has been overperformance led by TD, and this is more so due to prior underperformance given the U.S. anti-money laundering fallout, which capped the U.S.-based assets of $434 billion, which it has subsequently restructured a significant degree of its U.S. balance sheet, as it was near the limit at the time the cap was imposed, as well as the bank notably divested its stake in Schwab for $14 billion early this year. So there has been a significant shift, probably more so than the other banks in the last couple of years. So it was underperforming, but year to date, it has done phenomenally with a 51% total return. So amazing. that is actually the capital returns with no dividends. But if we take a step back and focus on the broad valuation shift, the years on a price to book basis, we can see a notable uptick in valuation, shifting from an average of 1.6 times at the start of the year to 1.87 times. So that's still increasing its forward expectations quite a bit, even though the results, and of course it is a bank, your book value per share every quarter should be expected to tick up barring any significant downturns. The market is valuing banks at a higher premium than what it was. And this is even after the April crash due to tariffs, resulting in Q2 earnings across the banks really being dampened by high performing loan provisions for credit costs due to high uncertainty. So effectively, those are loans which, on an idiosyncratic or individual basis, that they're performing fine, but because macroeconomic uncertainty is so much higher, the bank takes a performing credit provision. But they can, lots of times, they will release those credit provisions if nothing comes to case. So if tariffs, the whole issue falls apart, tariffs are no longer an issue, they will release those provisions, which will actually cause a big jump in earning during those quarters as they would release those. But in Q3, uncertainty appears to no longer be at least accelerating. It plateaued. Peak uncertainty was a comment which many of the banks were making, something along those lines, with performing credit provisions falling significantly sequentially. So the Q2 or the Q3 earnings, you can see just on the graphs there, strong performance across the board, with the exception of National, which did fall from the quarterly results, but very strong performance for the Q3 results across the board, really coming down to the commentary around just the outlook is better. It's as simple as that. The macroeconomic outlook is better. And that is something which you really need to be conscious about when you are investing in financial assets, especially large financial assets. It is bound by macroeconomic conditions, good or bad. So looking forward into 2026, the big question will be CUSMA renegotiations, which are set to begin in July, which who knows with the American administration at this time, are they going to just completely throw a wrench in it? As at this time, CUSMA really has safeguarded Canada for much of the tariffs. Most companies and people who were importing and exporting weren't really even actually applying to be exempt under CUSMA before, but now we have about 80%, depending on the metric you use, of the Canadian exports to the US being covered by CUSMA. So if that agreement breaks down, shifts substantially, you could have significant shifts in the Canadian economy as well, the banks, of course. But our Canadian dividend clients, as well as VIP clients, can look forward to reading our full special report in the very near future, which will go further in depth into all the banks, as well as the subprime lenders, which are quite interesting at this time. But yeah, I don't know if you guys had any comments there.
Yeah, we definitely have some updates on some companies that are already in coverage there, and some recommendations there of, essentially what you should buy. Maybe not completely inside of the big five, six banks there, but there's certainly going to be some recommendations for clients within that report as well. And we look forward to that. I happen to have a preview of it, and it's a great report. It's well done, well put together, and we're really happy to be sharing that over the next week to clients.